This is the All-Star Charts podcast with JC Peretz. Hey guys, welcome back to the podcast. Today, JC sits down with Steve Straza, Technical Analyst at All-Star Charts, and their guest, Brian G., who you can find at Alpha Charts on Twitter. This was a fun conversation because it's all about the evolution of becoming a technician. I think this conversation will provide value for investors of all kinds, regardless of age or time horizon. Price is what pays, and that's what this episode is all about. Enjoy.
All right, everybody. So we're joined today by Brian G. at Alpha Charts on Twitter, as well as Steven Straza, technical analyst here at All-Star Charts. What's up, fellas?
Hey, guys. Glad to be here.
So Straza and I, we talk all the time. I talk to you enough, but Brian, I don't get to talk to you nearly as much as I would like. We've had some conversations over the phone, and obviously we chat on Twitter. And just, Straza and I are just both big fans of yours. You do great work. So what's up? How did this all start? How did the charting first begin?
Yeah, great. Thanks, JC. I'm a big fan of yours. I've been following you for a long time and really grateful to be on the show. How did it start? Like, my journey kind of started back in the late 90s. I was still in high school, grade 11. And in 99, I took this course in high school that was called Creative Consumerism, right? Like, didn't really know what that was about, read the syllabus, and it was like, stuff about personal finance. And I thought, okay, that kind of sounds pretty cool. Took the course, teacher starts the class saying, this is going to be the most important stuff you're going to learn in school. So pay attention, right? And it was really eye-opening because, it was all about like, what are stocks? Stocks are ownership in businesses. What is compound interest? When you look at a compound interest table, like, your eyes just open. You're like, wow, like, this is powerful stuff. Like, if I, stick to this for 20, 30 years, this could really snowball into something meaningful. And now the thing is, this was like late 90s. I had no idea what was going on in the markets. That, we had this huge tech mania going on. And so I come in as a passive investor, all excited, all energetic. I put my summer farm work savings into some mutual fund. And then I go off to college, basically for 5 years. I have, don't follow the markets at all. Come out of school, check to see what my portfolio is at. And it's surprising to see that, it's done nothing. And it was actually quite a roller coaster to get to that nothing too. There was this massive bursting of the tech bubble, then a, resurge back up to that same level. And so I kind of got me thinking, I'm like, wow, this is it's actually a lot tougher in practice than it is when, just reading about books about compound interest. The reality is much different. And again, I didn't really think too much of it. I just kept my funds the way they were, did some jobs right out of school. And then 2008 hit, right? And then I was like, wow, another 50% crash in the same decade. This is really, how does this happen? How do these big run-ups and booms and busts happen? It really piqued my interest and really got me more into thinking about, actively managing my portfolio. And unfortunately, my first kind of segue into active management was, I'm kind of explaining my journey, and I'm going to talk about every mistake I made. And it's anything you can think of, I made every mistake that's in the book. So my first kind of foray was okay, let me look into economics, try to understand how this puzzle works, listen to all the talking heads on CNBC. And then, soon enough, you start realizing, hey, it's really, really tough to take a bottoms up approach and analyze every little gear in the market. And you know what, the market doesn't really care. You can come up with some fancy opinion, a complex prediction about the future, yada, yada. And the market doesn't care.
So then hold on. So then this is before you decided to take your CFA, correct?
This was actually around the same time. So around 2008, 2009, that's when I actually did my level one.
So hold on. So Straza, did you ever consider doing the CFA or no?
Yeah, I passed level 1.
You passed level 1 of the CFA? I didn't know that.
Yeah, when I was at SAC.
Oh, no kidding. And then why'd you stop?
Because I didn't want it. I thought I didn't really enjoy it.
Got it.
That's when I started focusing on technicals. But at SAC, they were like, we're not going to pay for your CPA. Get a CFA. So I was like, all right.
Sure, if you're paying for it, I'll study for it, I guess. So you passed level 1. That's a hard task. Good for you. I didn't know that about you.
Yep.
So then, Brian, so you decide, okay, I need to learn something because I've seen the market get cut in half twice in my short experience. So I'm going to get my CFA?
Well, the CFA was more, again, I'm coming into the markets, like all I really know is like personal finance, and I'm kind of coming in, I'm like, okay, I need to do active management, but like there's so many ways to do active. You can do value-based fundamental data, you can do economic, and then eventually I landed to technical. But getting there, it wasn't like obvious in the beginning for me. Like I'm engineering guy, analytical, like trying to understand how everything kind of works. So that kind of maybe worked to my disadvantage. And so I was, just gravitated towards like, listening to like basically all the guys that, kind of are famous for like, seeing the 2008 crash, and then subsequently they remain bearish because of
egos, we call them.
Egos, exactly. Yeah. And so, it's kind of exciting too, like a big crash like that happens and you're trying to like, okay, how did this disaster happen? And then, there's movies made on this stuff. And so long story short, like, kind of going into that arena, that kind of made me think, okay, well, maybe the CFA would be, like that would give me the tools I need. And, the CFA, like, the program itself, like you learn a lot of cool things in there. And I think what that really is more useful for is like if you want a career in finance, if you want to do like, let's say corporate finance, those kind of fields, which really, I mean, I don't really see myself doing that. I was more just interested in learning something that would help me with markets. And eventually over time, I realized that was a different kind of set of tools that I needed. And so kind of what kind of happened was like around, I would say like 2009 and 2010, that's when I started like, discovering blogs like, yours, Chris Kimball, Peter Brandt, all these guys that were just kind of openly sharing all their wisdom, all these charts. And then you kind of look at the charts and you're like, whoa, like that was the next aha moment that I had, right? The first one back in the 90s was like compound interest, all that. The next one was like, wow, like price action, like price has memory. Price, is something objective that you can kind of, it's not like accounting data that's like, full of assumptions. It's price is pure. And now the thing is like, kind of coming in early as a young TA technical analyst, I was abusing technical analysis. I was doing all sorts of crazy stuff like.
So hold on, how many indicators did you have on your charts?
So that's exactly it, right? Like, you tend to think.
Well, how many? 4, 6?
Well,
how bad?
Well, it varied. Like, I mean, I think I had like, like I was doing. I remember I had this like one like quantitative system that had like 6 different indicators on it, and oh gosh, like I was like just data mining, like setting these parameters, like like to like basically make the back test look really well. I did all sorts of stuff that is really embarrassing to admit.
You got to do it though. You have to go through that process. You got to do all sorts of stupid things that you're embarrassed about. Like I don't even share blog posts from 2012 and 2013. I'm embarrassed by them.
Yeah. I have as many indicators as stock charts would allow in my charts back in the day. So,
and you still see people do it. And I think it's a rite of passage because at a certain point it hits you. It's like, oh, got it. I don't need 20 indicators. I just got to pick one that makes sense to me and that I like.
That's exactly it. Like, it's okay. So indicators is one thing. And then it's like, your time frame is a huge one. It's so easy to just gravitate towards like intraday charts, daily charts, because you're just so like, you just want to make profits, like, in the short run. And the challenge is like intraday charts, daily charts, it's full of noise and you can easily get whipsawed, confused, stopped out, fighting trends. Like, oh my gosh, like I was notorious for fighting trends.
Tell me
right?
a story. Tell me a story of you fighting a trend and learning a lesson the hard way.
Okay, I got a good one. So I'm from Vancouver, BC. Like, it's how we talked about like, what's that? Exactly, gold, right? Like there's that chart that floats around on FinTwit that's all about like home bias, home country bias, regional bias. Like, if you're in the West Coast versus East Coast, like, you favor different sectors. And being from Vancouver, I've worked in the mining industry, and just like I just had this bias towards gold mining stocks, right? And this was like kind of like 2011. We just had like a 10-year bull market, epic bull market in gold, while stocks did nothing. And that added to that bias of like, gold is where you want to be. And after gold had peaked in 2011, we all know it started this long bear market. And, but the thing is like every year, like 2011, 2012, 2013, I was the guy, coming in being like, yeah, this is the bottom.
This is our year. The gold bugs are back.
This is our year, right? And just forcing that trade to work. And so like every like couple months, it would, I thought it was setting up, and then it would flop again and make new lows. Trends persist, right? You learn that lesson the hard way. Strength begets strength, weakness begets weakness. And you start realizing that idea, that concept, it's a powerful one, right? That was the next aha moment, is don't fight trends. So number one, compound interest.
Yeah, I love how you do that. Yeah. Like you're finding, like you're like, okay, compound interest one, got it, understood. Oh, price action, it has memory, got it. Oh shit, don't fight trends, got it.
Yeah, exactly.
These are great lessons. Like anybody listening out there, like hello, like Straza, how long did it take you to figure all that out?
What, about the time frame or just not chasing?
All these lessons, like it takes time. Like you don't just, somebody listening out there for the first time, it's like, oh, okay, yeah, I understand now. Don't fight trends. No. Go fight those trends and learn it the hard way, right?
Yeah, exactly.
I fought them for forever, and I don't regret any of it. I would never do it again now, but it took me a while.
It's called post-traumatic stress disorder.
Exactly.
That uranium trade I did like 10 years ago, I'm still losing sleep over it.
I think everybody has a story about gold too, I feel like.
Yeah. Well, gold is the one where it just like the sentiment, like, it's a 10-year bull market. How could you not be like, bullish?
Well, one thing I've noticed, Brian, just looking at your most recent post, is you mentioned time frame, right? In the beginning, looking at daily charts and intraday charts. But the first thing that stuck out to me when I'm looking at pretty much most of your posts that you write, you are posting monthly charts and weekly charts. I don't see daily charts at all.
Yeah, I rarely ever do daily charts.
How mature of you. Very mature of you.
Yeah.
You focus on the structural trend and
yeah, exactly. Right. So, there's this like, what's a trade-off. So like the shorter the time frame, the more susceptible you are to noise. But on the flip side, you can potentially get a better entry or exit. And on a longer time frame, like a monthly chart, you have very little noise. It's mostly signal. You can see the main trend. Now, the problem with a monthly chart is your entries and exits are going to be really bad. So I kind of find that a weekly chart is a nice sweet spot, like where if you kind of just look at the market like once a week and you kind of look at, okay, what do all the charts look like? Have the breakout levels held? You kind of get like a nice balance between not getting whipsawed too much and getting a pretty decent entry. I can talk about, like the exact process I use a little bit later. I'll just kind of wrap up like the journey I took, right? All the different aha moments that I had. Yeah. So like after kind of finding all these blogs out there, kind of looking at how these experienced traders have been, approaching the market, what kind of stuff they look at on the charts, just kind of learning, right? And again, I'm working like, engineering jobs during the day. I don't really have that much time. I kind of come home and kind of just glance at some of these blogs, kind of just have it kind of like sink in. also the personal experience of trying to like fight trends, that's like sinking in. And, it's just kind of like everything's just slowly kind of like coming together in my head. So years kind of go by. And one thing that I kind of like, anytime I talk to somebody that's really interested in trading, I always say like, you got to put in the time, right? Like when we all come out of school, we're young, we don't really have any capital, we don't have any experience. You have to slowly learn about the markets. You have to slowly accumulate savings through, working. You got to try to live within your means so that you can accumulate the capital you need for trading. In that process, you're going to probably blow up your account a couple of times. You're going to learn all these mistakes the hard way. But you know what? Guess what? Like, that's the time to do it. When you're young and you don't really have that capital, like, go out, make those mistakes, pay the university the tuition fee, or pay the markets the tuition fee.
I think that's a great point too, because like I always say you need to, when you pay your tuition, it has to be enough that it hurts,
right?
And when you're young, you can lose a small amount of money, but it could still feel like the world. So you still learn that lesson the same way.
Yeah. At the time, it feels like, oh my God, like I lost X amount. And then, years go by, you save up more with good market returns. Like, all that in hindsight looks like, okay, well, that was, in the grand scheme of things, like that was, not bad. And I was glad that I made those mistakes while I was young. And so that's the thing. Like, you really have to persevere, right? You're going to go through all these different hiccups. You're going to go through all these different mistakes. And the important thing is, as long as you keep sticking to it, you keep saying to yourself, okay, I'm going to learn this. And, for me, fortunately, there was just enough of those aha moments just sprinkled in that just kept me hooked. So like every time, I'll learn something that was eye-opening, I'd be hooked. I'd be, passionate, hard, working hard. That just kept me going. And then there was like the next aha moment I had was after kind of seeing, what TA is all about, playing with charts, kind of doing that. But again, I was fighting trends. I was making things complex. And I was like, I need that next kind of like thing to really, the next aha, right? And I think this is around like 2012, around there, 2012. So Meb Faber, which JC, you had on your show. So he published these two
Strazen's
papers.
A big fan of Meb. Big fan. We're all big fans of Meb.
Yeah. Meb's a cool guy. His podcast is really cool. So 10 years ago, Meb publishes these two papers, like really simple, like, easy to understand. One is called, like I have it here. It's a quantitative approach to tactical asset allocation. And then there's another one, relative strength strategies for investing.
That was a good one. Yeah.
Yeah. And, like after reading these papers, I was just like, whoa, like here I was like, making my life so complicated, like doing all these like fancy indicators, short time frames, gazillion trades, and just paralysis by analysis. And then here's this guy that just outlined a really simple approach to trading markets. And if you read those papers, what's the approach? It's like, you choose like a couple asset classes, like, you have US stocks, non-US stocks, bonds, and maybe a commodity fund, right? And then what you're doing is you're just applying, past 1 year momentum. Like, what's the relative strength? What's the strongest asset class over the past year? And if you kind of just hold that for, every month you do this check and you just hold the strongest asset class or the two strongest, the alpha you get is just mind blowing. And, these are like backs tests that are done going back to like 1920s. This, like, we're talking like a century of data. This is something that's persistent, this momentum anomaly, strength begets strength.
And it's a lot simpler and easier than doing all these crazy indicators and back tests and building out all these things in Excel, like I'm sure you were.
Oh, absolutely. So, I look at this and I'm like, there were so many different, like, things happening here that, like so many different light bulbs going off. And on a very fundamental level, it's okay, don't fight trends. Momentum is strong. Don't stand in front of a train that's headed towards you, right? Like that's just dumb. And number two is look, you can be simple. Like you don't have to, do all this crazy complex stuff. You can do this thing that takes you just, let's say, half an hour a month or an hour a month. It doesn't take that much time. It's really simple. It's objective, rules based. That's the next light bulb.
Brian, are you saying that to be a technical analyst, you don't have to be in front of your computer all day, every day? Is that what you're saying?
Yeah. Believe it or not.
Do you hear that, ladies and gentlemen? Are you listening to this man? Do you hear the words that are coming out of his mouth?
Yeah. No, like, so you can be simple. You don't have to spend much time. And then here's the other thing, like, how easy is it to FinTwit is like crack. There's so many like cool, sexy charts out there. There's somebody throwing like, a sentiment indicator like from this website, or like the seasonality thing, or these, like, there's so many things that you can look at and then just be confused, right? Like, and again, going back to like, Meb's work, it's like, okay, look, I don't need to look at all these other things like sentiment or seasonality or all this. I don't need to look at fundamental data. I don't need to be watching CNBC or listening to that, Paul Tudor Jones interview or that, guy talking. All I need to do is look at price. And even that is like, I don't need to spend hours a day looking at price. So yeah, long story short, like that was like the nudge that I kind of needed to really kind of turn my my trading around. Around the same time, there was another guy, Gary Antonacki, that was doing the same kind of writing the same kind of research papers, really simple, tactical strategies using momentum. And then I really started like, getting in touch with Gary, going back and forth, learning from him. He's been also like a really good mentor. I think it was like 2014, he wrote a book, Dual Momentum Investing. And that's a really good one to check out because, it really goes through the history of like, all the people, all the different traders in the past century that have, used momentum and they've been successful. So it's a really, so all of that work from Gary, from Meb, just looking at how a simple momentum approach can be, powerful. Now it's like, okay, well, now that was like, that aha moment that I was like, okay, now let's, really start applying this. And so one thing that I kind of like, I kind of took that work, and as you can see, I'm still using charts, right? I'm not doing quantitative systems that are in these papers. I'm kind of using more of a, charting, a somewhat discretionary kind of approach. So the reason why I kind of started applying it using charts is I kind of like, one thing with these quantitative approaches that are just using like a moving average or a past 1 year relative strength, you kind of see these systems and they've worked phenomenally from 1920 to like, let's say 2009. And, like a century of just trouncing the S&P 500. And then right around, the March 09 lows. So this rally that we've had for the past 10 plus years, it's been a very kind of, splintered rally, right? There's been all these, like 2011, 2015, and then we know 2018, 2020, there's been a lot of volatility in this bull market. And a lot of these like, simple moving average based systems have really gotten whipsawed, and they've actually underperformed the S&P. And so what I really found is like, if I apply those same kind of principles that I learned from Gary and Meb, if I apply that to charts and I just look at weekly charts and I'm looking at, okay, first I'm actually doing a momentum scan, right? So that's the foundation, the heart of the approach is, okay, what's the leadership in the market? Like, is it banks and industrial commodities, or is it tech? What's the leadership? What's really like, showing the strength? So you focus on that high level, and then you drill down and you say, okay, let me now look at the charts for banks and or tech or this sector. And, what's got the most attractive setups, like, and by setups, I mean, again, like, if you look at all my charts that I post, they're weekly charts. It's just one horizontal line. I like to keep it simple, stupid, right? Like above line, bullish, below line, bearish. And
well, in many cases, the market makes it binary like that, doesn't it?
Yeah. And, like one thing that resonates with me a lot is like, I, I love your tweets, JC. Like, they're always like, just pounding that concept, over and over again, right? It's like, above line, long, and below line, hey, it's not my problem. And I love that humor that you put in, and like
because it's not my problem. If I'm not in it, it's not my problem. Like the fact that gold has been underperforming for what seems like forever, that's their, like a lot of people in Vancouver, it's their problem, not my problem.
Yeah, exactly. Move on. Like, that's time you could be spending, like, in other assets making you money, right? Like, why make your life difficult?
So hold on, let's pretend we do want to make our lives difficult and we do want to buy gold. Is that what we're doing? Are we buying gold here? Are you bullish gold?
Maybe like I see you guys are doing playing a tactical bounce in gold. I'm kind of more of a longer term. Like I like to kind of hold things for weeks, months, if I can. And for me, like, okay, number one, from a momentum point of view, gold is still one of the worst sectors next to China tech and, marijuana stocks. Like,
you get beat up in Vancouver for saying things like that.
And then if you look at, like an index like GDXJ, like that's breaking like an 8-year base, right? So like these are things that, I've learned the hard way. Like, it could have a strong rally from here. It could not, but it's not the risk reward for me. It's not there. There's better opportunities that I can be pursuing with my capital. And again, I'm just trying to make my life easy. If there's something that is showing strength, and we'll get into this, like, the market sectors that look, phenomenal here. There's many.
Okay, talk to me. What looks phenomenal?
So last week I just wrote a blog post, just kind of summarizing my overall, kind of view of the market from a high level down to like the different parts of the market that look good. So, broad stocks, like you got to be bullish stocks. Like, you have the US, you have Canada, you have Europe, all within 3% of their all-time highs or 52-week highs. Like how could you be bearish on that? US sectors, 9 out of 11 US sectors are within 3% of 52-week highs. Again, that's super bullish. You guys have been great at showing the long-term charts of foreign indices and how many foreign indices are coming out of, decade, 2-decade bases. And they just kind of broke out last year. So lots. And, so the big picture, where things are relative to their 52-week highs, like you got to be bullish. You look at, like crypto, like, again, you guys have been all over crypto. Look at how many.
Yeah, because they're in uptrends, breaking out of bases, right?
Yeah,
what's there not to like?
What's there not to like, right? Like you look at like an Ethereum monthly chart, and we're currently at the highest price. We've exceeded all prior monthly closes. That's bullish. You look at some of these, up and comers like Cardano, Solana, like these things are just coming out of these beautiful, like the weekly charts are just like, you have a strong momentum and you have breakouts. Like what's, like you just can't get any better than that. So crypto looks good. Stocks look good.
I also see that you have a chart of Solana and Cardano as well as Ethereum.
Yeah.
You long the Solana?
I am. So I have, most of my trading is done through IB, but then I also have a little bit on one of the crypto exchanges, and I do a little bit there. It's not a huge position, but you
identify leaders, and those are definitely two of them, right?
Yeah, absolutely. Right.
And then the way we look at cryptos is we just look at them as more stocks. Like you talk about like looking for areas that are showing strength, right? Because strength, right? More strength tends to follow. Yeah. And when you go chart by chart, sector by sector, stock by stock, commodity by commodity, you look all over the world, what stands out, is, you just said it, Ethereum breaking out, Cardano, Solana, these things are breaking out to new highs. What's there not to like?
Yeah. Like that's the thing is like, why exclude anything from your universe? Like you got to treat all of these
because it's too hard and I don't understand.
Right. That's exactly it. Like people are so crippled by, like, oh, this is, like there's look at how many growth investors would not touch commodities. And if you look at,
that's
like
part of
I have this,
my commodity bullish thesis. This commodity super cycle we've been talking about since last year is exactly that. Is that people are like, the way I learned it was BSC, bonds, stocks, and commodities. There are 3 asset classes, but people have conveniently forgotten, speaking of recency bias, right? People have forgotten that there's this third other asset class.
Yeah. So I do this chart that basically plots 52-week highs versus lows, right? And just a scatter plot. I got like 60 ETFs on there, and just looking at just a quick glance just gives me an idea of like, okay, what are the strongest? What's the strongest stuff out there, right? So if you look, the strongest of the strongest crypto, then the next one is going to be stuff like your rare earths, your lithium, your shippers, and then
Steel.
you have sorry. Steel, yeah, steel is on there. It looks like uranium's like kind of like inching its way like into the strongest area. Banks are up in there. Within tech, you have like cybersecurity that's really like strong right now. Now, if I was like just a tech investor, I would be excluding myself from all these opportunities that are happening out there. And why do that to yourself? So A, why fight trends? And B, why like just ignore a big chunk of the market when it's like I treat every sector the same. If it's strong momentum and it's breaking out, I want to be long, and vice versa. Like if I'm like really like my personal bias, like I love software. I think AI and all this stuff is the future. But if it's making lows and it's got weak momentum and it's breaking down, I don't want to be long. So all these like different things are lessons learned the hard way. And you just learn over time that, hey, you strip down all the non-essential things in your process and you just dumb it down to what's really matters. One thing that I'm still guilty of is, and I've written this blog post recently. It's kind of looking at intermarket. So it's like, if this is doing that, then this should do that, right?
Yeah.
and you kind of like, you can really get paralysis by analysis by doing that. Like if you can, like, that stuff, right now it kind of seems like, everything, all the intermarket is lining up, right? And that's kind of, it kind of feels elegant.
Yes.
But if it doesn't line up, you don't have to just, be out of the market. Like, if the stuff that is in your portfolio is above a trend line, if it's still like strong momentum, hey, you still want to be long.
Treat every trend on its own merit, right?
Yeah, exactly. So in terms of process, basically focusing on leaders, identifying the trend of the leaders. So I always think, momentum is more for generating the alpha, and then trend is more for like, risk management. So if we're below a line, we want to be out. So those two combine. And again, this is like kind of like the work that Gary and Meb have been kind of showing that, you need the momentum and the trend. So it's both of those tag team together are a powerful combination. And, again, we're not predicting anything. We're not turning around, tossing and turning at nighttime, second guessing ourselves. It's all rules based. And, again, make your life easy. Yeah.
One thing I want to add is by looking at your charts, one thing I really like, I don't see any diagonal trend lines. I see a lot of horizontal support lines.
Yeah, that's we were actually talking about this on Twitter, eh? Like your talk with Jason, reminded me of Alex Elder's book, Trading for a Living. And I remember reading about that in the past, that, diagonal trend lines, they look amazing. They look super cool on a chart. And, just like, there's stuff that's like, you can draw like a 10-year diagonal line. And it's like, wow, look, like here's the S&P hitting it in 09 and in 11 and 15. And, you can get carried away with that stuff. Diagonal lines, you can really, your personal bias can really come out. You can totally draw them however you want to. Yeah, basically just to fit your the narrative you already have in your head.
Yep.
The other thing is, as you mentioned, like the market knows horizontal prices. They know support and resistance. Yeah, and that makes sense. The market doesn't know diagonals. and that's like, yeah, like 100% agree with that. You want to be as simple as possible. You want there to be little room for subjectivity. You want to be objective. So how do you be objective? So like the momentum scan I do, that's purely like, okay, what's 52-week highs and lows? That's just pure, data. And then let's look at the charts. And yeah, for the charts, you got to have a bit of an eye. But if you just have a horizontal line on a weekly chart, there's very little room for manipulating that to based on your biases, right? So to make it clean, make it simple on yourself. One thing, JC, every time I hear you, like, when you do like a podcast, a YouTube, like, you're speaking like as simple as it gets, right? Like, I'm thinking like, if somebody from elementary school is listening to this, they can probably understand what you're saying. Like, it's not, you're not speaking like, at a, at a complex level. You're speaking very basic English. It's simple to understand. Just keep it simple. Yeah.
And then, so I like how you said that you have not issues, like you struggle with overthinking the intermarket analysis, because that's a problem that I definitely had for a long time. It still is today, but I certainly have come a long, long way. Like in the old days, the fact that interest rates keep falling, like maybe 10 years ago, that would have prevented me from buying a tech stock, right? And then now it's like, well, I guess interest rates aren't participating. Yeah, all right. Well, I guess we're buying bonds too. All right, fine.
Yeah.
It's been a great example of that. I was talking on the phone with a friend earlier, and he sees the market very similar to all three of us. And he was saying, like, if you overthink this market, it's probably the worst thing you could have done this year. And if you're trying to look at all these intermarket relationships and try and glean anything from them, they were very mixed. They've been mixed all year. They're just starting to come together, maybe. But if you just focused on price, it would have kept you on the right side.
Absolutely. Yeah.
So what else are you trying to work on then? So you're working on that. You're trying to get better at keeping that simple, and seems from where I'm sitting, seems like you're doing a hell of a job at that. So kudos to you. What else do you think needs work in your process? And Straz, I'm going to ask you the same thing.
Yeah. What else needs work is, so one thing that kind of, I always found entries are super easy, but exits are a little bit tougher. So, entries, you get a breakout, you identify momentum, you get a breakout, you get long. That's super easy. And okay, well, how do we know now when to get out? And for that, there's a few different things you can do. And, like, for example, like you can find something that is new leadership. So old leadership gets replaced by new. And that's actually the one that I do the most. The other one is like, if something hits resistance. So like a good one was MJ. So like earlier this year, it came out of this nice base and it ripped in like 2 weeks. I forget what, I think it was like a 2x in like 2 weeks. It was just
the marijuana ETF.
Yeah. And then it basically came up to those, 2017, 2018 highs. And then guess what? It stalled. And then it's been in a pretty big downtrend ever since. Right. So that was like an example of, okay, here's something that had a monster run. It just got slammed right into, multi-year resistance. So that's the time to take some off. The other one is, you'll have something, TAN, the solar ETF. So that was a good one where early, after the pandemic crash, it was one of the first ETFs to really start showing the leadership. And I picked it up on the scans, waited for that breakout to happen. I think it was like around May, got long. And then it just kept making a series of successive higher bases and breakouts. And then eventually, earlier this year, it broke down from a topping formation, and that was your sign to get out. So that wasn't, it didn't hit resistance.
So in February. In February.
Yeah, exactly.
Yep. And like so many other things.
Mm-hmm. Yeah, like so many things. Exactly. Yeah.
What about you? What about you, Straza? What are you working on? What do you think needs improvement?
You tell me. I think I've
how much time you got?
Yeah. I think I've come a long way with not overthinking a lot of stuff, whether it's breadth or intermarket, but I still fall into the trap, as you know, of trying to build out some grand macro thesis. Because when you're looking at so many charts, like I'm doing the RPP report now, where we look at everything from commodities, stocks, currencies, crypto, we cover everything. So right now it's easy to say, oh, the dollar's, falling. We're starting to see mid caps and cyclicals pick it up. Like banks are working. And it's easy to fall into that trap and go like 5 derivatives out and say like, oh, then that means that yields should be back above 1.4, right? You should short bonds. Well, on Friday, when everything was working, bonds were higher too, and yields were lower. So just trade what's in front of you, I would say. A lot of times I take it too many derivatives, as you would say, Jason.
It sounds to me like this is not just a JC issue or a Brian issue or a Straza issue. Like investors, once you discover the intermarket relationships, it becomes very easy to let that, go down all those different rabbit holes. And like Straza said, you think that the dollar's going to go up, so the dollar's going to do this, so then gold's going to do that, and then interest rates are going to do this, so then we're going to short emerging markets. It's like, what?
Yeah.
So, okay, great. All right, so listen, we talked about a lot of things. I can't let you go without asking you, what's the best trade on the sheets right now? We're finishing the summer. What's the best trade on the sheets?
Okay, so I mean, you got to be long crypto, right? Like, it's strongest area of the market. Lots of recent breakouts. Ethereum on the monthly. If tomorrow is not a complete reversal, like that monthly chart looks really good. Within tech, I like the BUG ETF, bug cybersecurity. And you know what? You gotta love the industrial commodities like uranium, steel. I think these have had months of sideways that, within powerful, strong uptrends. I think these look really good to me. Yeah.
And let me ask one more thing. What has you focused on small cap, cyclicals, and value? I don't disagree, but a lot of people would say tech is still leadership.
Yeah. I had this chart where, if you kind of just, again, we're going back to that intermarket stuff, right? That I was just saying that we shouldn't really be doing. But if we kind of look at, look at the last 5 years of like a lot of like these sectors are, rate sensitive, right? So if you look at SPY versus KRE, SPY versus XLE, SPY versus IWM, growth versus value, and even gold, if you put all those next to TLT, and then you kind of see like over the last 5 years, if it kind of, 2018 to 2020. So you've had golds and bonds did well, stocks were choppy, and within stocks, tech was, the best area. And so that's that growth to value shining when, bonds are doing well, gold's doing well. And, if you kind of look at, so that chart, I can post it on Twitter, all these different areas of the market. So like, if we're bullish stocks and bonds, to me, I don't, bonds and gold to me just don't, weak momentum, like I was mentioning, GDXJ made a breakdown.
Relative weakness.
Yeah. So those are areas that those are no touch, no go zones for me. And, I like
that. I like how you said that, the no-go zones. I like that because it doesn't necessarily mean that you're shorting bonds and gold. You just don't want to go there.
That's right. Yeah. And, so, if we have, like if this is, a strong bull market, which, everything I look at suggests it is, like bonds and gold and, all this stuff is weak. So, what really shines in that market? It's, your industrial commodities, your banks. And again, if you look at the leadership board that I look at, it's the momentum is suggesting that, look, the leaders are like, rare earths, lithium, steel, like we talked about, and that's where you want to be. And I think small caps, like, again, if you look at, again, that chart that I have, like, SPY versus IWM versus bonds versus gold, all that kind of, I kind of see it as like kind of like one big trade,
Well, I love it. Everybody out there listening, make sure to go and follow the Alpha Charts blog. So this is Brian G, and you can follow him on Twitter at Alpha Charts and at the Alpha Charts Substack. Did I get that right?
Yeah, you got it.
All right, rock and roll. Let's do it again. Thank you, Straza, for joining us. Thank you, Brian, for joining us. I learned a lot about you. I learned a lot about your process, and I will now be able to decipher even more from your charts when you share them. So thank you for that.
Thank you so much, JC. This was a pleasure.
All right, guys.
We hope you enjoyed today's episode. To catch up on all our prior conversations, make sure to visit allstarcharts.com/podcast. See you next time.